All right, folks. Okay. I'm sorry, Alexander. So we just about starting. So I put my mic on mute. Okay. Voice okay? Can you hear it now? Voice is fine. All right. Okay, let's go right ahead. Let's start off with our series of indicators. Well, before we start, I'd just like to go over the fact that from next week onwards, I will be in London for my workshop. And for those of you who are in FX Street, for those of you who are in London and are part of the FX Street meetup group, I'm also doing a presentation with the FX Street meetup group. It would be great to meet you folks personally. I will be there at the meetup group on 7th of November. I'm participating in the World Money Show, which is on 8th to 10th November. So I've got 3 events on the World Money Show. On Friday, part of a panel. I'm also doing one session on money management. And on Sunday, 10th November, I am disclosing the divergence technique, something which I regularly use myself, even as of today. Unfortunately, my website, there's something wrong with my website. It's not opening. 16th of November, I've organized my own workshop. There you go. It's called the Trend Flow Workshop, which is something I would, there is a part of moving averages in that which I want to discuss today. That is one of the reasons why I chose the moving averages, and we'll just go over that. So in London, from 7th, event on 7th November, 8th November, 10th November, 16th November. In between, also looking at some FX bootcamp or personal mentorship due to some inquiries. I'm conducting some personal mentorship, one-to-one courses from our office in the London Institute of Financial Trading. Anybody who is interested, of course, can very well join me or send me an email. All right, let's start off with moving averages. Now, this is the part of our series of indicators, using indicators correctly. Let me first start off with saying that all indicators are lagging, right? So price is ultimately the leading factor, and any indicator, if you use in the conventional way, which most of the traders use, you will probably get into a trade when half of the trend is almost finished, which is pretty late. And among all of them, the moving averages, I find the moving averages to be the most lagging indicator, especially the way the traders use them. Let me just briefly recap what we looked at. We looked at Bollinger Bands, the best way to use Bollinger Bands. We looked at the slow stochastic, which comes back to divergence. The slow stochastic is best used for looking at divergence. As you can see on my screen here, I do have a stochastic indicator with a standard setting, which I use on all the time frames to determine divergence. This is one example that I want to go over right now, combining the divergence vis-a-vis the moving averages. We had a look at the RSI, a unique way of looking or trading the RSI by plotting trend lines on the RSI. We had a look at the MACD by looking at, again, a different way of trading using the histogram bars of the MACD. Right, so now we are looking at the moving averages. Now, moving averages by themselves can be effective. They are effective, once again, if used properly. Let me just first go over the most conventional way that most traders tend to use the moving averages, which is the crossover. Going back again to the fact that what I repeat in each and every session that we have covered on the indicators, that never ever use indicators to decide your trading parameters, which simply means that you cannot decide on the entry of a trade or the exit of a trade or even a stop loss level of a trade based on your indicators, because it's going to give you the wrong picture. Let's be very clear about that. And if you're going to use the moving average, well, it's going to get you into a trend, or it's going to get you a lagging way of looking at the price. Now, this is a standard crossover. I never use the moving averages. In a sense, not in the conventional way. I'll show you some different ways today to use the moving averages, which are much more effective than these standard crossovers. Now, this is one standard crossover using 50 moving average and a 13 moving average. A lot of traders look at the moving average is that if you have a crossover, right? You have a moving average crossing over, like the 13 moving average crosses over the 50 moving average, you should go long. Yes, in this case, it's good. It gives you signal. Or you have the 13 moving average moving below here, you should go short over here. Now, if you look at it in hindsight, everything really looks good. If you look at it, of course, whenever there's a crossover, there's been a decent movement. Here also, you do have a decent movement. But if you look at some situations, sometimes, where you have a situation where you have a crossover and price, as soon as you get into a trade, let's take this one. Let's take this situation. You get into a trade at a crossover and price kind of retraces and moves down, and then it changes trend. Now, this is on a 4 hour. I'll come back to this, Dhruv, on why the 13 and 50, why do traders there are a lot of traders who use the 13 and 50. I'll come back to the setting of it, what should ideally be the correct setting of an indicator. Let me just first start off with the lagging part of it. Right? You would get in over here, you would probably be in profit for some part of the trade when price reaches down somewhere over here, and then price starts changing trend. Now, this is one of the things that in a moving average crossover specifically, now you can take a crossover of any moving averages. There are a lot of traders who use the 21 and the 50, the 13 and the 50, the 9 and the 21, the 5 and the 13. I mean, there are a lot of combinations, and we'll just come back to what do these numbers really signify. But bottom line is a moving average gets you into a trend very late. Let's take a simple example based on something which we call as a divergence. Right now, this, if you look at this, this is a classical bearish divergence where price makes a higher high. Let me mark the highs over here. Right, this is a high, this is a previous high. And if you look at the stochastic, we've discussed this, the best way to determine divergence is to look at a stochastic. You can see a divergence on any kind of oscillator, but this is best. We had price making a high and a higher high. You had the stochastic making a higher and a lower high. Now, this simply means it indicates a loss of momentum. Of course, there are ways and means on how do you confirm a divergence and what is the best place to get into a divergence. But let's just say that we would have got into the divergence trade somewhere over here. Right? This would have been my entry into a short. Now, if you wait for a crossover, and if you don't look at price action, and if you wait for a crossover, you will get into a trend over here. Now, on a 4 hour, you're talking about a difference. Right? On this standard 4 hour, you're talking about a difference of almost 90 to 100 points, which is huge. Now, in this case, of course, price has trended down and you were still in the trade, you will get it. But there are a lot of times, and believe me, there are a lot of times when if you wait for a moving average crossover, you get into a trade. Let's take this example. Let me just remove all of this. Right? Let's take this example. You have a moving average crossover over here. This is a place where you have the moving average crossover. This is where you would take an entry into the trade. And this is where price starts changing trend. Time factor. I'm just looking at the time factor. What you would have got is probably a move from here to down here, right? Which is roughly, let's talk about, again, we're looking at the 4 hours. We're talking about 80 odd points. And then price starts moving up. But since, and this is human nature, since you have got into a crossover, let's trade the hard right edge of the chart. You don't know what's going to happen after this, right? You've got into a moving average crossover. You expect price to turn bearish because price has crossed not only the slow average, even the fast average. So if first price crosses the 13 moving average, which is an indication of change of trend. Then it crosses the 50 moving average and you say, oh, this looks good. I mean, price has changed trend. It's bearish. So you enter, you wait for a signal and you enter on the crossover. And price starts moving down. Here, price starts to trend up again. At this stage, most of the traders, the new traders, I would say, this is where the traders lose money, is they are hoping against hope. Oh, the moving average crossover is good. So obviously, this is just a pullback. And of course, price is going to continue towards the downside. Let me just write it up. And you wait for some time, and boom, It moves up. It moves up not only above the 200 moving average. Obviously, the strong move takes out your stop. So more likely than not, your profitable trade turns into a losing trade. Now, believe me, in a moving average crossover, this happens quite a lot because moving average by themselves are very lagging if you use the crossover. Right? Now, the best way of using a moving average, let me go to this one. Now, this is a 200 simple moving average. A 200 simple moving average is a very important moving average for the simple reason that a lot of traders look at it. Institutional traders, institutes, large funds, they look at the 200 moving average. Now, this sometime earlier, maybe last year, I had discussed one 200 moving average strategy, which is a very unique and very, very effective. Probably if you do a Google search on it, you will get a 200 moving average strategy, which is very effective. What I did, of course, was take it one step forward and put down a precise trading plan to it. Where do you enter? What are your exits? But coming back to thing, I have seen hedge funds, large institutional traders who have black box systems based on the 200 moving average, that they simply look at the 200 moving average on the daily. If price is above, you go long. If price is below, you go short. Now, let's come back to the question as to what are the numbers? Why is the 200 moving average so important? Well, technically, most of the traders look at it because it's considered to be a yearly moving average. Now, out of 365 days in a year, if you take into account the weekends which are closed and the holidays, let's say Christmas and New Year's and some other, you have the Labor Day and you have the Independence Day, you have all these holidays. On an average, you have working of about 200 working days in a year. Right, so this 200 days in a year is considered to be a yearly moving average. Right, Mike? Okay, thank you. So most of the institutes look at this. Now, why does price react around it? It's because a lot of traders are looking at it. Now, if you, as a simple experiment, if you take the 200 moving average, plot it on the daily and on the 4 hours, even on the 1 hour, very effective. But on the daily and the 4 hours, you will see that it often acts as a very strong level of support resistance. So one of the ways of using a moving average is look at it as a level of support resistance. Right now, the Aussie, same thing. If you remember, we looked at the Aussie here, right? We looked at the bearish divergence on the 4 hour. Now, bearish divergence was confirmed by price hitting the 200 moving average and finding resistance and getting rejected. Can you see this? Exactly over there. Now, if you just go back, on average, on a lot of currencies, you will see the 200 moving average often acts as a very strong level of support and resistance on the daily and even on the 4 hour. Look at this on the 4 hour. It's right now on a support, a very, very strong support. After the divergence that we looked at, price came and found support exactly at the 200 moving average. Right? If you look at this, there are a lot of times, of course it doesn't work all the time, but there are a lot of times when price reacts around the 200 moving average. And once again, the reason for it is because a lot of traders are following the moving average. So it's a kind of a self-fulfilling prophecy. As soon as price approaches the 200 moving average, there are a lot of traders who expect a reaction over there, and they tend to take positions based on that reaction. So it becomes a kind of a self-fulfilling thing. And the 200 moving average, believe me, works. For the simple reason, as I said, that a lot of institutional traders are following the big money, what they call as the big dogs or the big guns, as they call. I find the concept very funny. But I honestly find the concept, I can imagine a room where you have these dogs sitting with their cigars in their mouth and controlling the market. Well, it doesn't happen like that. You have the big guns controlling the market. They're the institutional traders. Nobody can really control the market. But if you have the large funds, if you have the volumes basing their systems on this, obviously the market has some effect to it. Yes, Nicholas. Nicholas just made a comment that he's been using the 200 and the 100 moving average on the 1 hour chart. Very effective. It does. See, if you use the moving average, let's just get into this a little more. Do not, the first and foremost is do not try and use a crossover to enter your trading parameters. Right? Use it. Now, the first effective way of using a moving average is to look for a level of support resistance, which generally works on higher term time frames. On smaller time frames like the 5 minutes and the 15 minutes, there is a lot of noise in the market. So you will not find the correct levels of support resistance. 4 hours and above is ideal. 1 hour also, as Nicholas says, it does work. Well, it does work. That's one of the first things. So use the moving average for levels of support resistance. Secondly, use a moving average to define a trend. It's just as simple as that. Looking at this, a 200 moving average is a yearly moving average. Now, if the 200 moving average is flat, this is a situation where it's flat. That means price is not trending. Just keep it as simple as that, that you have a trend. The possibility of profits increase when you enter a trend. If price is flat, then try not to trade it. Now, this works on all time frames. Let's take this on the 1 hour. Now, on the 1 hour, this is a 200 moving average. You can see it's got a decent slope. Now, this is a pretty decent slope. So, which means it tells me that there is an uptrend to this. And you can see the levels of support also on this one. Right now, you can see it's slightly moving towards the downside. So, here, ideally, looking at the slope of the moving average, I would tend to remain short if I'm trading on this particular time frame. Now, there is a lot of difference. On every time frame, you might get a different trend. So you define your time frame, what time frame you're looking at, and based on that you decide. So on the 1 hour right now, I can see the moving average is dipping down. I would ideally want to remain short. So what I would do, that now the price is moving up, I would wait for it to find resistance somewhere. If it does and starts turning down, then that becomes a high probability trade. All right, now let's take this on the 15-minute time frame, just as an example. As an example, on the 15-minute time frame, you look at this. Right, let's just zoom this out a little. Nice slope, right? This 200 moving average slopes down really nice. So here you would tend to remain short on the 200, on the Aussie on the 15-minute. On the 15-minute, it's crossed this one, but the price is crossed. Remember, the crossover does not really mean too much. Has the 200 moving average started to slope up? It's not. Till the time it doesn't, do not think about longs. So that's one more thing. That's a good question, Ben, and I'll come back to this. I wanted to go into the entire gamut of the moving averages, right? We'll come back to this one. So use it here. Now, let's take this crossover that we were looking at. So let's discuss the numbers. 200 moving average, important, even in Forex. In equities, these do really work well. 200, 100, exactly what I said, Ben. The slope depends on the time frame. So you have to decide what time frame you are looking at. And base that on that particular time frame, you're going to look at your trend. Right? Let's take this chart. See, on the 4 hours right now, let's take the smaller moving average here. The 13 moving average, it's a down slope on the 4 hour. Now, if you look at it on the 15 minute, look at where your 13 moving average, it's on an upslope. So what do? You have to decide your time frame, and based on that time frame, you have to do it. Remember, if you're using multiple time frames, do not use the moving averages, because you will only end up getting confused, right? Because every time frame, the smaller you go down on the numbers of the moving average, the faster they react to price, and you will get a different picture on every time frame. Right? Now, coming back to the numbers. In equities, Forex also to a large extent, 200, 150. 200 moving average, 100 moving average, and 50 moving average are considered to be important. A lot of traders follow this. Once again, for the simple reason, 200 is a yearly moving average. 100 is considered to be the half-yearly 6 months moving average. 50 is considered to be the quarterly moving average. And now, if you look at it, if you break it down further, then you have about a monthly moving average if you have 20. Now, 20 is a very odd number. The reason why a lot of traders look at 9, 13, 21, 55 is they are Fibonacci numbers. Now, believe me, I use a lot of Fibonacci's in my trading. All my trading is based on Fibonacci's, but I have never really applied them to the moving averages. They say, a lot of traders say that if you base a moving average on a Fibonacci number, it's supposed to be more effective. Well, so be it. But that's one of the reasons why these numbers are there. The 100, the 200, 150, and after that you have the 21, the 13, the 55. These are all Fibonacci numbers, so a lot of traders tend to use them. Besides that, there is no significance. In fact, if you are using moving averages, I would encourage you to go to it by trial and error. Right? Let's take this example. On the 4 hours, I can see that the 50 moving average that I have plotted, price reacts around it quite effectively. Can you see the support, resistance, support, resistance, to pretty decent extent support. Now, if I can see that 4, 5, 6 times price has reacted around it, so I know on the 4 hour, the 50 moving average is effective. Similarly, if you want a smaller term moving average, do a little bit of experimentation, try and increase the number, reduce the number, use the best fit, but I really would not recommend it because it doesn't make sense. Believe me, price action is the only thing. So 2 ways that you should ideally use a moving average is look at levels of support resistance. As you can see right over here, we've marked it. Use those moving averages, which price reacts around to quite a lot of times. It gives you an edge to your trading, and look at the slopes of a moving average. When you're looking at the slope of a moving average, do not take into account smaller moving averages like the 13. Right? You can see that price, the 13 reacts to price very fast, so the slope really doesn't make sense. Use those moving averages which the institutes follow. So in this way, your 200, 150 are the good ones to follow for levels of support resistance and for slopes. Otherwise, they're all very, very lagging. Right? So 200 moving averages. Now, let me, before I come back to whether it should be, the moving average should be plotted on the close of price, the open of price, the high of price, the low of price. Well, I have one simple concept on all indicators. Do not play around with the settings. Most of the moving averages by default are calculated on the close. Keep it on the close. Because the minute, there is no end to it. If you start calculating it on the open, calculating it on close, calculating it on the high or the low, you will get a lot of different permutation combinations, and each of them may be effective, may not be effective. You just end up getting confused. But once again, I want to come back to this because there is one particular method which I use, which I will be using for my workshop. I call it the trend flow indicator, and we'll just come back to that in a moment. Let me take one example. Right now, I want to show you on the Canadian dollar. I'm looking at one harmonic pattern. Right now, based on my concept of the harmonics, price has found resistance at a 78.6 level. I'm expecting a move down. So we are, as you can see here, we are already in a sell over here. I'm looking for price to move down. Let's take this vis-a-vis the moving averages. Right? This is on a daily time frame. Let's take, let me just remove these. Let me take the Canadian dollar on the daily. Now, what I have done is my harmonics are based on price action. If I take the Canadian dollar based on the moving average crossover and I base it on the daily, what do I get? Let's just zoom it inside. I just wanted to show you this because this is really important. We had, let me zoom it inside a little more. We got a moving average crossover right over here, just 2 bars before. And what happened? Fibonacci levels, the levels that I follow, this is a level of support resistance. Price has stopped at exactly at a 78.6. Now, of course, it may not. That's a probability of trading. I mean, I may be wrong in what I do. I think it's going to go down. It may just retrace and still pull up. But if I'm long on this trade, if I was long in the Canadian dollar, I would have taken my profits. I am already short and I'm expecting price to move down. But let's come back to this. Right? It got rejected at the 78.6. If I was basing my trades on a moving average crossover, I would have entered the trade on this bar. And just 1 bar ahead and price gets rejected and starts moving down. This is often what happens when you use a moving average crossover, believe me. Let's take the same concept on the 200 moving average, let me plot this one. On a 200 moving average right now, we had nice support. Look at the Canadian dollar, how it found support on the 200 moving average on the daily and started moving up. This is the third point that I wanted to discuss. Price, especially on the moving averages which work well, like the 200. 200 I consider to be one of the best moving averages that you can use on higher term time frames. Believe me, not on smaller term time frames. Any reaction of price away from the the 200 moving average, it's like price has stretched beyond the means. And the more it stretches beyond the means, the tendency of price is to move back to it. As you can see over here, price had stretched way above the 200 moving average, and eventually it started moving back towards the 200 moving average. Here, we do have a pretty decent move away from the 200 moving average, and if price had stopped at an important Fibonacci level, which is also a zone of support and resistance, this was a nice zone. Right now, these are very important. Price action, this was a zone which was support, which has turned into resistance. So the possibility that price will move back towards the 200 moving average is very high, which gives me a stronger confirmation that yes, the USD CAD has a probability of moving down. So which increases the trade. Now, of course, I am not waiting for it to come back to the 200 moving average. My trade is based on the harmonics, so I'm looking at some target somewhere over here, or whatever the way that we look at it. But is this a point that I'm trying to prove over here? Right, so moving averages, when you use, remember the three important points. Once again, repeat again and again and again. Look at levels of support resistance. Look at the slope of the moving average to determine the trend on whatever time frame you are, and look for a reaction away from the 200 of any moving average. When price stretches beyond the means, it's like a rubber band. It will come back to it. So it reverts back to the means. So of course, you need an excuse for price. This is the excuse that I'm talking about. You need a technical pattern that, okay, you think that there's a possibility that there's a technical pattern, it might go bearish. Now you know. Now, in case it had decided to go bearish when the 200 moving average was very close to it, right? Let's say the 200 moving average was somewhere over here, where my cursor is right now. Then I would not really think about short, because I would expect price to find support on the 200 moving average and move up. These are different combinations that we are looking at. Okay, last point. I do hope this helped you understand the moving averages a little more. Last point. Now, in the workshop that I'm doing on the 16th of November in London, I have a system which I call as a trend flow strategy. Now, this is what it is. This is a combination of three different indicators. Now, believe me, I'm not much to use indicators, but over the years of my trading, I have devised these. I don't think so, bullish pips. I don't think this is recorded. Right? Over the years. Oh, it is. Oh, great. That's nice. Thank you. Thank you, Mohit. I have devised these indicators. There are two indicators which are proprietary, which I will be giving away during my workshop. One is these zones of, I call it the FibForex support resistance. You see these bars over here? You have strong moves. The other one is this double stochastic indicator, which is based on certain calculations that I have, and I have combined it with moving averages. Now, what are these moving averages? What I've done, see, everything has a purpose. I use three moving averages over here. There are two moving averages, the ones which are formed on bands. They are the same moving averages which I calculate. One is calculated on the high, one is calculated on the low. So it forms a band. And the dark blue one is a regular exponential moving average. Now, each of them has a purpose. I'm not using moving averages just for the sake of moving averages. The simple fact is, one of the most simple things, when this channel is flat, do not trade. When price is inside the channel, do not trade. When price is inside the channel. When price comes out of the channel and the exponential moving average also moves out of the channel, it is an indication of a very strong move which is coming up. And I take a confirmation from my indicator, my proprietary indicator, which has already given me a sell over here. and my stochastics are showing me bearish momentum. So I have three factors going for me. Now, if I'm using this particular system right over here, it gives me a higher probability. Now, my point over here is all indicators, this is what we've been covering in all the last 4-5 sessions over here, is use the indicators, but use them correctly. So I have looked at the characteristics of the indicators and tried to make the best use of them. You can do the same. This is no rocket science. I mean, this is not a trade secret. It's just a simple, effective way of using the indicators. All right, folks. So I think that was about it. I hope this moving averages helped you understand a lot about it, and I hope you can use them properly. If you have any questions, feel free to ask. You want any more information, this is my email. Please feel free to email me at any given time. I will always reply back. If you are in London, I would like to meet up with you. Come over to the World Money Show, participate in my workshop, come up to the FX Street meetup presentation. It's always nice to meet. I always look forward to meeting all the traders in person. I make friends very fast. All right. Well, thank you very much. Oh, absolutely, Vedan. In fact, higher the time frame, if you use these concepts, that if you look at levels of support resistance and the slope of a moving average, they are much more effective on higher term time frames, weekly and monthly as well. I always recommend using indicators on higher term time frames. Bullish pips. Well, how do you get to? Oh, you just drag it. Let me just show this to you. It's a MetaTrader thing. Right now, I have one stochastic over here. If I need to put another indicator, let's say I need to put the oscillator RSI over here. Right? I just take this RSI and I drag it down into this window. There you have two of them. Voila, magic. All right, bullish pips, I hope you got that. No, Dhruv, no. Let's not take that as a gospel truth. When price is moving away from the moving average, when it stretches beyond the moving average, it tends to revert back to the mean. But you need, if you have a technical pattern telling you that price is ready to move down, then it will tend to come towards the moving average. It's not necessary that once it starts moving away, it's going to come down. No. Right? Forex tends to trend a lot, and price might just keep moving away and away and away. Right? Let's be very straight about that. All right, folks. Well, it is always good being over here. Anybody has any questions, feel free to send me an email. You have an email. I'm always here. And as I said, if you are in London, if you're based in London, I would love to meet up with you. Let's meet up. I'll be in London for about almost a month or so. Right? And good talking to all of you. I hope this helped you understand the moving averages. And I'll see you for the next session after I'm back from London over here. Bullish pips, I was in Singapore a year back for one of my workshops. I organized one workshop. I don't know whether I don't remember telling you about it, or maybe I didn't have your email address, but next year again in Feb sometime there is a schedule for another workshop in Singapore. I'll let you know about it. All right, folks, any questions, please send me an email, and time is up. I'm sorry, I had some questions, but we can just talk about it if you can send me an email. All right, I think time is up over here. I have to leave, and I'll see you folks later. Well, have a good trading week. Have a nice weekend. And good trading days. I'll see you folks when I'm back from London. If you have any questions, as I said, please feel free to send me an email. Thank you so much for being over here, and I'll see you folks later.